Good morning. It's my pleasure to welcome you to our China event, and it's my special pleasure to welcome our distinguished panel of experts. I can't think of a better panel to discuss the Chinese economic outlook and the economic challenges that lie ahead. In the order in which they'll speak, they are David Dollar, who is a senior fellow at the Brookings Institute. Before joining Brookings, David had served as the country director for China at the World Bank, and more recently, he was the US Treasury's economic and financial emissary for China based in Beijing. David will be followed by Tianlai Huang, who is a research fellow at the Peterson Institute for International Economics. Before joining the Peterson Institute, Tianlai worked at the Brookings Center for Asia Policy Studies, and he taught at the Johns Hopkins School for Advanced International Studies. Daniel Rosen will be next, and he is a founding partner of the Rhodium Group, where he leads the firm's work on China, India, and Asia. From 2000 to 2001, Daniel was a senior advisor for international economic policy at the White House National Economic Council and National Security Council. He'll be followed by Derek Scissors, who's a senior fellow at American Enterprise Institute and a colleague of mine. At the American Enterprise Institute, he focuses on the Chinese and Indian economies. He is concurrently serving on the US-China Economic and Security Review Commission and is the chief economist of the Chinese Beige Book. By way of introduction, I might point out that the acute financial crisis at Evergrande, the world's most indebted property developer, who has now been declared as being in default by the Fitch rating agency, has drawn attention to the size of the Chinese property and credit market bubble. It's also raised questions as to the possibility that we might be on the cusp of deflation in that bubble. The size of the Chinese property bubble has to be of concern. According to Harvard's Kenneth Rogoff, the Chinese property sector has now increased to a size that now accounts for almost 30% of the Chinese economy. That is roughly double the size of the property sector in most advanced economies. At the same time, Chinese house prices in relation to incomes are very high compared to other countries, while it is estimated that 1/5 of Chinese homes are presently unoccupied. Equally troubling would seem to be China's credit market bubble. According to the Bank for International Settlements, over the past decade, Chinese credit to the non-government sector has increased by 100% of GDP. That is a faster rate of credit increase than preceded Japan's lost economic decade in the 1990s, or that which preceded the 2006 US housing market bust. It might be noted that while the Chinese government's control of its banking sector likely precludes a US-style housing and credit market bust, the deflation of the Chinese housing and credit market bubble will likely be occurring within a very difficult domestic economic context. President Xi's Common Prosperity Program appears to be reversing some of Deng Xiaoping's structural reforms. China's labor force is now shrinking as a result of its earlier one-child policy, and China's trade relations with the United States remain fraught. How the Chinese economy performs over the next few years will be critical to the rest of the world economy, given that it is now the world's second largest economy, and it's the world's most important commodity consumers. While it is true that the Chinese economy does not have direct financial links to the world's financial system, a marked slowing in Chinese economic growth would have major spillover effects to the rest of the global economy. No longer would Germany, Australia, and China's Asian economic partners be able to count on a rapidly expanding Chinese economy for their exports. No longer, too, would the commodity producing countries in Latin America and Africa be able to count on buoyant international commodity markets to support their economies. It is against this background that I've asked our panel to answer the following 4 questions for around 10 minutes, and each of the questions will be followed by 5-minute discussion among the other panelists. So the first question will go to David Dollar, and the question is, over the past decade, China has attained rapid economic growth through unusually high investment that has been credit-fueled and property-intensive. How sustainable is the current Chinese economic model? What might be the alternative to Chinese economic growth model? For Tianlai Huang, the question is, the difficulties at Evergrande have undermined confidence in the property sector and have drawn attention to China's housing and credit market bubble. How best should Chinese policymakers respond to this bubble? For Daniel Rosen, the question is, President Xi has embarked on a common prosperity campaign with the purported objective of addressing the country's wealth inequality. What are its implications for the Chinese private sector and the country's long-run growth prospects? And finally, for Derek Scissors, the question is, China frequently indicates that it believes technology is coming to the rescue, either in supporting aggregate growth or in boosting living standards, even as income gains slow. How valid are these claims? So without further ado, it's my pleasure to hand the floor over to David Dollar to answer the question about the Chinese economic growth model. David.
Thank you very much, Desmond. It's a great pleasure to join this panel. These are really interesting topics. You know, your question for me about the sustainability of China's recent growth pattern, I think there's a simple answer, which is basically it's not a sustainable growth model. But let me go into a little bit more detail with 4 points. First, as you said, Desmond, following the global financial crisis, China's response very much included an increase in investment. They accelerated the growth of the capital stock up above 10% per year growth. And I think a simple way to think about the problem now is, while that's come down slightly, basically the capital stock is growing at about 10% per year, but GDP growth has slowed down towards 6, or probably more like 5 now. And that's very powerful evidence of diminishing marginal returns to investment. And intuitively, if you overbuild the capital stock, what's happening with the more recent investment is you're building infrastructure that's not really needed. You're building apartments that are not occupied. So you're making investments that are not generating GDP. And that is basically an unsustainable growth model. Now, the second point I want to make is that the financial issues, which I think other panelists will discuss further, are very much the mirror image of the real problem. You know, I started with the real problem, that there's too much investment and a lot of it is very low return, but there's a financial side. A lot of that is fueled by credit, as you said, Desmond. You know, so the growth of credit has stayed at a very high rate, but as I said, the growth of GDP has slowed down very significantly. And what you get then is a rise in the stock of credit relative to GDP. And that's an indication of increasing financial risks. And we'll get into that in some of the other topics. Now, the third point I would make is that it is possible to adjust the growth model. I think, you know, the growth rate's already slowed down toward 5, as I said. So when we talk about adjusting the growth model, part of that adjustment will be accepting a somewhat lower growth rate than China has been used to. I think pretty straightforward way to think about this, you know, clearly they need to bring down the investment rate. We're discussing the excessive investment in real estate, but you know, also infrastructure and other areas. So they need to bring down the investment rate. At the moment, their national savings rate is very high, and it's quite similar to the investment rate. So their investment is largely domestically financed. if the investment rate comes down, which is already starting to happen, if that savings rate stays high, then China will have a growing trade surplus. The broadest measure of the trade surplus is basically the difference between your national saving and your national investment. And while there are different needs around the world, I would say in general, China's economic partners are not going to welcome a large increase in its trade surplus. So it's a kind of adjustment. You can imagine an adjustment where investment comes down, savings stays high, and China runs a very large trade surplus. I don't view that as a sustainable growth model for a variety of reasons. So that, to me, that would be a kind of, unsuccessful adjustment, and so ultimately not really an adjustment. Then the fourth and last point, and I probably, spend the most time on this, is it is possible to have what I think of as a more healthy, sustainable adjustment. And the simple way to think about that is China needs to invest less in stuff, so less in buildings, housing, buildings, factories. Infrastructure is actually a big part of this as well. The debt problems of local governments in China very much reflect that the more recent rounds of investment in infrastructure have financed a lot of things that are not high return. And so the local government's left with the debt, but not an asset that's really increasing its GDP. So they need to move away from this investment in stuff. And I think the natural thing to do is to spend more money on people. We've been indicating for a long time that China needs to consume more, in a sense, increase its consumption as a share of GDP. If they bring down investment and saving, then naturally consumption has to be going up. These are shares. And there are ideas about how you could stimulate household consumption to be increasing its share. And we can get into that a little bit if people want. But I want to emphasize that the direct method that I personally would recommend is that they need to put more money into education and health, which both are recorded as consumption in the national accounts. So while they're investing a lot in physical capital stock, there are a large number of children going to school in the countryside who are not getting particularly good education. So if you're thinking about areas where you could usefully devote resources, either facilitating more permanent rural-urban migration, which would involve putting more resources into the urban schools to deal with migrant children, and or putting resources into rural education so that the future workforce gets a better start on life, essentially. So I think education is an obvious area where they could spend more. And then the other one, Desmond referred briefly to the aging of their population. There's going to be an extraordinary increase in the number of people above 65. And in particular, there's going to be a huge increase in the number of people above 85 years old. And China is underspending on medical care, assisted living, and various things to take care of people. So for me, there's just a kind of whole obvious agenda of education and health. And you can refer to those as investments, but they are a different type of investment than building apartment buildings. I don't think that this is going to have an immediate impact on China's growth in any sense. It's recorded in the national accounts as consumption, and I think there's a lot to be said for that distinction. So, just to close, my basic point is they need to shift the allocation of resources away from physical investment toward these more social spending areas. And that's going to be a more sustainable growth path. It'll be a slower growth path because I don't think spending on health and education is going to have a big short-term effect on GDP growth, but it'll be sustainable. And then I just want to end by reminding you that the point of economics is not GDP growth, the point is human welfare. And so if this kind of adjustment is more sustainable and it's actually educating the young people who are in the countryside and the migrants in the cities and dealing with the aging population and their health and assistance needs, that's a pretty good growth model. Thank you very much, Desmond.
David, thank you very much. That was a great answer. I guess a couple of questions that just popped to my mind, but then I'll turn it over to the other panelists. What you seem to be saying from an international perspective could have really very profound implications, that what we could be seeing is not only China slowing, but shifting away from goods, which could have huge implications for commodity producers or for Germany that's been exporting goods to China. So that looks like, I just wonder whether you can agree to that. The second question I'd just ask is, are the Chinese already beginning to make this kind of shift? And if you could just say a word about the magnitudes that we're talking about. It just seems that you've got an incredibly high level of investment. So the shift that you're going to have to get on the consumption side is going to be huge. This isn't going to be an easy kind of adjustment.
Yeah, no, so I think I'll take that second part of that question first, Desmond. I think you're right that the savings rates, it seems to be about 45% of GDP, and other fast-growing East Asian economies, which we thought of as high savers, were at 35% at this stage of development and have come down further since then. So adjustment from 45 to 35, that is a very big adjustment. There's no question about that. So there's reason to think it might be bumpy along the way. And then you're right that if they do shift away from the investment, such an investment heavy model, and I think they have to shift to some extent, it's definitely going to affect prices of iron ore and energy and other things. But I guess what I would say to some of the commodity exporters is, China sustainably growing at 5% with some shift occurring towards the items I was talking about, meaning that a lot of goods demand will be growing less rapidly than GDP, that a sustainable growth rate of that is going to be better than having China continuing the unsustainable growth model and then ending up with a really major crisis that collapses, that really brings down their economy, commodity prices, et cetera. But yeah, you're talking about a big adjustment for the world.
And just before I turn it over to the panel, China is likely to start this process soon, or is it likely to be kicking the can down the road again?
Well, I think it's already happening. One of my many frustrations with China is that there's pretty good data from the 2010 census on education and rural-urban divide, et cetera. They haven't released a lot of that from 2020. So our understanding is a little bit out of date. But, 2010, I could say they were seriously underspending on their needs for education, for example, and healthcare. And, this is going to be the labor force of the future. I think more than half the young people are still being educated in the countryside. It's the labor force of the future, and they're really not putting a lot of resources into it.
Great. Anybody on the panel would like to comment?
Yeah, I have a follow-up to what you just said, David. I'd like to push you on that, which is, you may have even written about this 10 years ago. People have been telling the Chinese this for a long time, and the data has been coming at us. We can argue over the range for demographic changes, when it's going to hit the core blow is, but we've all seen this, and yet their response has been really, really slow. So why, what is going to cause them for the light bulb to go on? And because these changes take a long time, as you suggested, and we all understand, you don't snap your fingers and suddenly have a better educated rural workforce. What's going to get them to move with the alacrity necessary to get them to have a good 2030s, to put it very generally?
Desperation is my simple answer, Derek. I think, we often only get big policy changes when we're in a fairly desperate situation. And that's just an unfortunate thing. So some aspects of this adjustment, I think, are definitely going to happen because they're very worried about the financial developments, the bankruptcy or default, I guess I should say, of Evergrande and Kaiser. So we're definitely going to see some parts of the adjustment, reducing the investment in real estate. They've reined in some of the lending to local governments, for example. So, that's all in some sense, a negative part of the adjustment. Now, you're right, it's a little bit harder to get some of the positive part of the adjustment, but other questions that we're going to get to, for example, on common prosperity, you can, that can be spun in quite a positive direction as far as Chinese welfare and growth model, or it could become a nightmare, frankly. So I'm looking forward to hearing that discussion about how you spin common prosperity and to be consistent with these more macro changes I've been talking about.
Qinlai or Daniel, do you have anything to add?
Well, I just want to echo, first of all, thank you, Desmond. I'm really happy to be on this panel. I just want to echo David that I totally agree that instead of keeping investing on stuff, China should invest more on its people. And two groups of population came into mind. One is what David just talked about, the Chinese rural youth, because of the one-child policy and the demographic shift. The majority of China's future labor force are actually born in the countryside. And there was an excellent book last year written by Scott Rozelle and Natalie Hell at Stanford named Invisible China that shows China is having this quiet human capital crisis in its countryside. And it's both an education crisis as well as a public health crisis. And the other group of population that came up to my mind is the migrant workforce, which is a significant portion of the Chinese population. And they're among the lowest wage groups in the country, and their wage growth is slowing than the average wage growth of employees in urban China, and the social insurance covers too few of them. So I think to reform this obviously unsustainable model featured by high debt, high investment, China should definitely try to invest more on its people. But we have, and I want to make another point on consumption. We have heard time and again that China wants to make consumption a bigger share in its economy. Actually, since the great financial crisis, China has been doing that, but I think it has largely failed because if you really look at what China has done, it hasn't really done much to improve income distribution. There has been limited social transfers and social safety net is still very, very weak. And people talk about tertiary distribution in this whole context of common prosperity. And I think even if you see an increase in tertiary distribution, it's gonna have only very marginal impact. And the most bizarre thing, in my view, is that there is not much taking place on the tax front. Among the issues that are essential, I think, to common prosperity and other things, I mean, is tax, but there's basically nothing that has been done. I also think there's very little wealth effect coming from China's rising house prices. I'll talk about that in greater detail later. And I think the housing bubble has become a bigger constraint on consumption and other more productive areas in the economy, but does not seem to me that bringing down the housing prices in those top tier cities in China is the goal of the government's current ongoing campaign in the property sector. They will at most try to slow down the rise of housing prices in the top tier cities. So, I mean, I don't see, it's not clear to me so far based on the evidence how China is really going to make consumption a bigger share of the economy.
David, would you like to reply?
Desmond, I would actually just be as happy to move on because I like you. I think your 4 topics are interrelated, and I've got some things to say about other topics. Okay.
Great idea. Chinlai, would you like to tell us about the property sector?
Sure. Well, I guess what is on everybody's mind right now is Evergrande, since it's now in default. We see that the Guangdong provincial government has already sent a working group to Evergrande, and the risk committee that is made up with mostly senior executives from SOEs has been set up at the company. What they're doing now is to fully understand first how much debt, especially those that are off the balance sheet, Evergrande actually owns. And it's not clear yet how they will exactly sort out the Evergrande problem. But one possibility, I guess, is that the government will follow the HNA model in dealing with Evergrande, meaning that there will be a debt restructuring. The company may be divided into several separate entities, and the government will eventually take over it. The other goal of the government intervention, of course, is to coordinate with local governments across the country and make sure that the unfinished Evergrande projects get finished and delivered to the home buyers because of social stability concerns. Second, on the slowdown of the broader property sector, if the current property downturn continues and worsens into 2022, there will be a further slowdown in growth, no doubt about it. Given property is such an important pillar industry in the Chinese economy, it contributes 25 to 30% of China's GDP. And land sale proceeds on average accounts for almost 40% of fiscal revenue for local governments, and 27% of all bank loan balance is property related, including mortgages, and 60% of the total assets owned by urban Chinese households is property. Therefore, property sales continue to drop. Banks will see higher NPL ratios on their books, and shadow banking will, like trust companies, which is an important source of funding for developers, will get hurt as well. Suppliers of developers, which are mostly SMEs, will see higher defaults on their own debt and possibly greater unemployment. And local governments will have trouble selling land, and it's going to pose a threat to their fiscal conditions as well, which in turn will translate into more defaults of local government financing vehicles whose debt is usually collateralized by land plots or properties. Actually, a lot of those are already happening, but if the current downturn continues, things will get even worse. In the long term, I mean, the Chinese government is hardly unaware of those risks. That is why it's taking actions now, trying to stabilize the property market. The most important signal is that the Politburo this week said it wants the housing market to stabilize in 2022, and the hard landing is not acceptable. The central bank has also cut the RRR this week, and some more easing measures may be rolled out in the coming weeks and months, including more credit easing on property development loans. Disbursement of mortgages may get expedited as well, and we may even see regulatory measures like regulatory forbearance, asking banks to roll over loans to developers, and probably also a temporary relaxation of the 3 red lines. So hopefully a hard landing can be avoided. But in any case, I think the property sector will inevitably go through a great deal of distress in the foreseeable future. Over the long term, this model of property-led growth is simply not sustainable and needs to change. There is already a serious affordability crisis in China's top-tier cities, and the debt that has been built up in the system is getting more and more dangerous. The recent spate of credit events with property developers, including Evergrande, shows that the financial sector is already facing greater distress. On that, the past decade has seen a rapid increase in real estate-related loans, including mortgages. From 2011 to mid-2021, the share of property-related loans, including mortgages, in total loan balance has increased from less than 20% to more than 27%. At the same time, total mortgage balance as a share of property-related loan balance increased from 2/3 to more than 70%. This also means the share of capital allocated to the sectors other than real estate in the real economy that are more productive and efficient is shrinking, which is definitely not a good thing for the overall productivity of the economy. On the other hand, mortgages have remained high quality assets on the balance sheets of banks. NPL ratio for mortgage loans is actually the lowest among all types of loans. And this may be related to the high down payment requirements in China, typically of 30% for first-time home buyers and even higher for other types of home buyers. And in contrast, property development loan quality has been deteriorating in recent years. The NPL ratio for that type of loan across the banking sector has increased nearly threefold from 2013 to 2019. Other than that, what is equally worrying is that many Chinese developers, including Evergrande, rely on shadow banking channels such as trust companies to finance their activities. The total balance of lending from trust companies to the property sector is more than RMB 2 trillion. In the case of Evergrande, lending from trust companies accounts for more than 40% of its total financing. So any credit events with developers will cause problems in the shadow banking sector as well. So why is there so much debt in the property sector? This is largely because the Chinese housing boom is built on a model with local government's financing need at its core. Local governments across China get nearly 40% of total fiscal revenue from selling land and property-related taxes. Some local governments on the coast, where land prices are relatively higher, even get more than half of their total fiscal revenue from land sale proceeds. And in China's top-tier cities, land supply is restricted because China's urbanization strategy has long been one that encourages the expansion of small cities and towns while putting a cap on the size of its largest cities. And this has led to significant mismatch between supply and demand in housing in top-tier cities, where China's population inflows are concentrated. And local governments in those cities therefore push up land prices in order to meet their financing needs, which ultimately translates into runaway housing prices in those cities. For property developers, they keep leveraging their assets, including land plots and projects under construction, to borrow from banks and non-banks to purchase new land and develop housing projects. And when land prices go up, their collateral will be worth more and they will be able to borrow more. Therefore, the debt ratio of Chinese developers is on average as high as 80%. So the interests of local governments, property developers, and banks are closely aligned. And this model relies on high property prices to work. Ultimately, if the Chinese economy is going to transition to something more sustainable, it has to bring changes to that unsustainable model of property-led growth. This means local governments will have to look for alternative sources of fiscal revenue other than land sale proceeds. I think that is why China is now trying to introduce a property tax, because it will help with, it will be a new source of fiscal revenue for local governments, besides from its function of taxing speculation. And perhaps greater dividends from local SOE sector can be another alternative, but more is definitely needed. The central government, on the other hand, I think needs to think about what to do with the current decentralized fiscal structure, in which local governments are constantly making their ends, are constantly struggling to make their ends meet. I think it also means that China needs to deal with the affordability crisis in its top-tier cities, where high housing prices are becoming more of a constraint in those places on consumption. It also means the land supply needs to go up in those top-tier cities, and speculation needs to be more heavily taxed, and the development of the rental market needs to speed up, and the list can go on and on. Most importantly, I think China needs to find a new growth engine other than property to sustain its growth, but it looks like it still has not found one. I'll stop here. Thank you.
Thank you very much. I just got, one question, and we've got a question, from the audience. I guess my question is that the Chinese property bubble and credit market bubble, looks larger than that Japan had some time ago. My question is, can China avoid, what occurred in Japan, that it now goes on to a very much slower growth path for a long period of time because it's got such a large overhang? That's my question. The question I've got from the audience is they're wanting to know is what are the possible domestic political implications of the economic adjustment that China must soon go through?
Well, to your first question, I think China does have the capacity to avoid a systemic meltdown of its economy, like what happened to Japan, because first of all, China's capital account is not liberalized, meaning that China has very little foreign capital in its financial market and housing market, and the size of the derivative market, including mortgage-backed securities, is also very small, so there won't be much contagion in the financial sector. And second, like you mentioned in your introductory remarks, Desmond, the largest creditors, the banks in China, are almost all state-owned, and Chinese regulators are, strong and credible, so they're able to use administrative measures like regulatory forbearance to require banks to roll over loans to developers. Although that will certainly be encouraging moral hazards further again. So the bottom line is it's unlikely that China will face a Japanization, but it will have huge implications domestically on its economy.
Thank you. Just before turning over the panel, do you have anything to say about domestic political implications of the economic adjustment China's got to go through?
Well, I think the one I can think of is the relationship between the central government and local government, because this current model of a property-led growth is at the core of this model is the local government's financing need. And if that is going to change, if the central government decides to reform this whole fiscal structure, then this whole relationship between the central and local governments will have to change. And I think that will have some political implications.
Okay, let me hand it over to anybody on the panel who would like to comment. Daniel.
Yeah, this is a terrific presentation. Thank you. I have a question. When we introduced the notion of property tax, finally, that is a big new bite out of the household budget. It changes the underlying value of property if it's not a costless asset to hold, but there's a tax stream associated with it. So after we sort of normalize the current bubble and kind of mania about property in China, do you think that on a nationwide basis, and of course it's very different between tier 1 and tier 5 cities and everything in between, but overall nationwide, would you expect the introduction of these taxes and the sort of dialing down of expectations about speculation opportunities in property to reduce average housing property values today by closer to 3% or closer to 30%? Or where would you land in between there? It seems to me like you could tell a story around both of those. Thank you.
Yeah, well, can I piggyback on that? It seems to me that in terms of the domestic political potential fallout, I think that Dan's question very much gets at a key issue. I think if housing values fell by 30%, I'm pretty sure there'd be a lot of angry middle-class people in China. And if the adjustment, maybe a little bit more than 3, Dan, but if it goes toward 10, I think people can accept that. But 30 or 50% decline, that's going to be a political crisis. So I guess I would be welcome Tianlei's perspective on that. Does he agree with that?
Well, definitely, David. I do think local governments face a huge political pressure on that. That's why they are trying to, especially in top tier cities, the local governments are trying to avoid a sharp asset price decline. And the other point is that if the property market does see a sharp property price decline as much as 30%, then probably a lot of households will be disincentivized to repay their mortgages, and that will threaten financial stability as well. Oh, by the way, I should mention that I think because China is still a partially urbanized country, and a lot of people are still moving from rural China to urban China and from smaller cities to bigger cities. So there is real legitimate demand behind this whole housing boom, especially in top tier cities. So I think the likely scenario is that the property prices in top tier cities will continue to rise, but slowlier than what we see now.
Can I ask another question?
Go ahead.
Yeah. It seems to me that well, I guess I'm interested in Tianlei's perspective on this question. Desmond, you cited some figures on the overall role of housing, construction, real estate in the economy. That just seems too large to be sustainable. That's going to have to come down. But how far is an important question. So Tianlei, it often struck me that there's underinvestment in the top tier cities and overinvestment in a lot of so-called tier 3, tier 4 cities. And that with the right policies, there's potential for quite a bit of construction to continue in the top tier cities, that are actually meeting demand from people. I wonder if you agree with that.
Oh, definitely. I think different Chinese cities face different housing problems. In top tier cities, the problem is there's too little supply and too much demand. And in smaller cities, the problem is on the opposite. There's too much supply and there's too little demand. That is why we see there's such a high, there's so many homes that are unoccupied and cannot be sold out. And that's also what results in the so-called ghost cities that we often see and hear in media stories. Yes, there is such a mismatch in supply and demand, and that shows up in different ways in different tiers of cities.
Yep, but all of this doesn't sound too good. It sounds like they've got a bubble in terms of property prices. They've got too large a property sector, but politically, you seem to be saying that they can't afford to bring the property prices down to more reasonable kind of levels or to make the adjustment. So am I to conclude that just for political reasons, they've got to keep this unsustainable model going until somehow something like a range of defaults causes it to stop?
Well, I think that's a real likely scenario. I mean, I think the best thing China should do now is to continue to raise people's income and continue high growth so that this bubble over time can become less dangerous. That's the hard reality. I think there is a consensus even within China that this model is not sustainable. But if this bubble is to burst, it's going to bring everybody down. So the best thing to do probably is just to keep the current model going while letting it buy us some time to figure out what the new model will look like.
Right. Okay. Daniel, would you like to talk about the Common Prosperity Program?
Thank you so much. And I'm so pleased to be here with good old friends that I've learned a lot from over the years, like you and Derek, and meet new voices. Tianlei, it's the first time we've been together for this. And David also, of course, a mentor to me. Common prosperity. I think common prosperity is essential. It is absolutely the right flag for Beijing to be flying right now. It's essential to achieve China's long-run growth potential, whatever that potential is, whether it's in the sort of 5 to 5.5% range that I think we'll see Beijing try to establish that as a new line of defense for next year. I think there's a credible argument to be made that without irresponsible amount of property activity, it's hard to construct more than like a 3.5 or 4% story for China in the medium term. But whatever that number is, common prosperity is a linchpin for it. It's got to be achieved. Presently, there are severe structural imbalances in China's growth model that David was talking about that are eating away at long-term potential. The longer it takes to solve those, remedy those imbalances, the lower future potential will be. China has, as was noted, severely overinvested in physical capital stock. A decision that was very positive for growth from 1978 until sometime into the 2000s, but overstayed its usefulness as the core element. Infrastructure, steel mills, capacity in so many heavy industrial sectors that happen to be carbon intensive, let's note, and nowadays property. Of course, the big millstone around NEX. And as David noted, underinvested really quite terribly in human capital, including healthcare and education that were mentioned. But I think we can also now start to consider environmental welfare as a human capital investment. If the environment is not a healthy and sustainable one, then you are eating away at human capital as well as diminishing the capital stock value of land and other things. To sustain higher returns and social stability, the political question that we started to talk about, we absolutely have to remedy this. And common prosperity is going to be part of that. The question is, are the emphases that we have heard from leadership associated with common prosperity campaign so far this year the right ones? It's not a question of common prosperity, it's a question of implementation and what we're doing about it, I think. And will they lead to the kind of rebalancing, structural adjustment that we all agree here? And China's economists all agree with us too, is absolutely the objective. Well, let's think about for just a second what we actually have so far in terms of evidence in the evidence file for what has been done on the common prosperity field so far this year. We have a ton of political pronouncements and rhetorical statements about the importance of common prosperity. And, you know, that's important, right? It is crucial for leaders to put a vision out there and to give it some voice, right? And get people rallied around the case for leaning more toward common prosperity as opposed to independent initiative and entrepreneurship, right? Which got more of the trumpeting, more of the bully pulpit over past decades. So political pronouncements are not, nothing, but they're not enough. So turning to the second thing that's been associated with common prosperity this year, regulatory crackdowns. There's been a vast amount of regulatory cracking down taking place that is labeled as part of common prosperity. And when I look at the regulatory crackdowns, it's not at all obvious to me that all of them should best be understood as an element of common prosperity, depending on how we define what common prosperity is. And then when we look at specific policy actions being taken, such as the rural toilet revolution, that's been very much in the news for all the right reasons over the past couple of weeks. I'm being a little facetious, but it is being branded as an important contribution to common prosperity. Some of these things, for example, center local fiscal reform to alleviate the perverse incentive to sell land to property developers locally, even if there's no need for that property in a third-tier city, but you have to do it because you need a revenue answer. You need some answer to the question, how am I going to raise revenue to pay for education and healthcare locally? And it is by land sale. So there's this perverse situation. We're talking about fiscal reform. We are once again talking about property taxes as the answer to fiscal reform locally, but we can't square it with the aspiration of 5.5% GDP growth coming full circle around to what we were talking about in property just a second ago. And so we're rebranding everything as common prosperity right now. And I'm finding it hard to sort of tease out what is new and different and more urgent and getting resourced differently right now that gives me a reason to increase my probability that common prosperity will be achieved in the medium term. A couple other considerations to throw in there, and then I'm going to stop. The more serious the campaign to shore up long-term growth with common prosperity reforms is, the more serious the short and medium term disruption of growth as we've known it will be, right? There is no costless way to implement a kind of policy change such as China requires to deal with those common prosperity needs. It will be taking income away from one sector or some industries in order to redistribute it in areas that will have a better return over time. But we're not creating a new, a new element of income in the national economic model. We're simply moving income from some sectors to others for the short and medium term. In the long term, if we do that well, again, to note David's keen observation that it's the diminishing marginal return on investment that's the problem here. It's not investment itself versus consumption in the first instance. So in the long run, if we redeploy investment in more human capital accretive areas, then China will wind up better off, have a higher trend potential growth rate in the future. But for the next 3 or 4 years, make no mistake about it, it's going to suck, is the technical term. It's going to be really, really painful. Growth is necessarily going to be much lower than it will be if we try to just drag on growth as we know it by softening up the 3 red lines around property, for example, which I fear is probably is what's going to happen. And then finally, I would just note that it wasn't always the case in China that when faced with the hard structural adjustment choices that needed to be made, government just kicked them down the road and kicked them down the road. I think Derek and David, whom I know well, and myself have long, been fans of important elements of the Chinese reform story post 1978, because so much of the hard stuff did get done. By and large, China was willing to do the hard work of adjustment to unleash future potential, the thing that takes the bite out of the medium-term outlook that I just pointed to. But that was during the salad days when catch-up growth, demographic dividends, and other tailwinds for China, like as my old mentor Mike Oxenberg used to say, a propitious external environment, a world that was ready to embrace and tolerate China's adjustment bumps in the road and not get all hung up on whether there was unfair trade, unfair investment, nefarious intent, and all these sorts of things. Now China has to deal with these medium-term costs at a time of headwinds, demographic headwinds, which is why we've seen stories in the past couple of days telling us that every party member has to have more babies as part of their job evaluation, which is just, I don't get me started. It's just too much for a Friday. But in any case, it's much, much harder now than it has ever been to deal with this trade-off between near-term growth and long-term growth. So common prosperity, yes, it's how we're going to get there. And I would say, one of the things that makes meeting and working with you guys so great is that we can think beyond partisanship about how we as reasonable economists would want to measure that. How do we evaluate whether China is actually doing the hard stuff and not just doing the politically rhetorical stuff to put common prosperity on track? Because if it's not on track, then we're not looking at a pacing threat. We're looking at a country that's going to melt down before too long. Thank you.
Thank you very much, Daniel. I'd be curious whether the other panelists, share your evaluation. You seem to be saying that China, the next few years, is moving to a lower growth path in large measure because you've got a lot of the headwinds that they'll now be facing rather than having the tailwinds, and they've got to do all of this reform. So it'd be good to get, just the panel's view on different growth. But before that, let me just ask 2 questions. The one is what they're doing in the name of common prosperity, is that reversing some of the Deng Xiaoping reforms? Are we getting more state control and clamping down on private enterprise? And the question that I've just got from the audience is somebody's wanting to know, that they're just saying that as part of this program, trillions of dollars have got wiped off of investments. Should the United States regulators be doing something to protect United States citizens from investing in Chinese companies and running these big risks?
Well, on the first question, are we reversing? The thing about common prosperity right now is that it's absolutely everything. I think it would be very difficult to come up with a list of anything that is not considered relatable to Common Prosperity Campaign right now, right? It's just virtually everything is being rebranded as Common Prosperity, I would say. I would observe that in Xi Jinping's Chosha article last month, included in there is an insistence that the basic economic system be marked by public ownership as the mainstay. Now, one can debate and probably find some language in the historical record that suggests the party will be able to assert that, no, that was always our core point of view, that public ownership should be the mainstay of the system. But I think the spirit of so much of what impelled China's growth and foreign interest in the Chinese growth model over the years was the presumption that that wasn't the end point, that actually the role of state enterprises was being reduced to only those sectors where there was a compelling case for the state rather than shareholder incentivized governance to decide how to use resources efficiently. And just a few years ago, I thought the market was supposed to be decisive in allocating all these resources. And now I hear that actually no, or market only within the cage of government control. As for those trillions wiped off, I mean, maybe US regulators should make that their problem. Perhaps the day after we regulate Bitcoin, and the day after we regulate big tech, and the day after we otherwise socialize the US economy. So apparently we're going to have a government body deciding what's a good investment and what's not. Trillion sounds like a lot. It is a lot. But in the context of the global financial system, these kinds of ebbs and flows of equity valuation happen not infrequently. I am very disinterested in seeing U.S. government claim that it has some responsibility to look after Americans chasing yield into Chinese securities or bonds.
Thank you. Derek, would you like to say something?
Yeah, I'll quickly respond to the question about growth. I think the trade-off here for the Chinese, and I think I don't want to put words in Dan or David's mouth, but I think they've said something similar, is you can either have a growth slowdown or you can have a growth slowdown where you don't address any of your problems. There's going to be a growth slowdown, and are you going to, within that period, do something that improves your medium-term outlook? I don't think there's any other option here. Maybe that's an exaggeration of someone else's view, but certainly that tension is present in their decision-making. What I want to ask Dan is, where does the CPC next fall come into play here? We have historical examples where the CPC has been a rallying point for, we're going to have a real change, meaning common prosperity is going to be real. We're going to put flesh on the bones and we're going to go forward, and it's not going to be everything, and we're not going to just get rhetoric. And we also have examples where, we thought we were going to get something like that and we got squat. Do you see the party Congress as mattering at all to this choice of whether we're going to make hard decisions, or it's just, look, there's a coincidence of a slogan and a major political event and they have nothing to do with each other?
Desmond, should I take that now, or do you want to collect a few?
Why don't respond, and then I'll go to David.
Okay. Sure. Well, first I would say we need to find a political scientist, I guess, to answer that. I really have a hard time finding any way to operationalize an answer, which is an economist trying to be true to the need for some sort of measurable basis or objective basis with which to answer it. As you said, Derek, there have been cases where party congresses were used as a fulcrum for change. My favorite, 1998, big year for Jiang Zemin, to set privatization of the property sector in motion, for example. And then there have been others where it didn't really matter. I will say this, the thing getting in the way of Beijing's ability to implement a meaningful reform agenda, such as we're talking about, is not the need for more authority from a party Congress or more consensus building at a party Congress. That is not the problem here. Whatever we want to say about, yes, they've got this sort of political choreography in mind, fine, but that's a choice they're making, that they like better choreography. It's nice to have choreography, but it's even nicer not to have a meltdown of your financial system. And what is a property sector meltdown today could truly become a shadow banking and then a banking system meltdown if there's not some urgency here. So I don't find it compelling to say we have to wait 1 year for this Congress to be behind us before we can expect responsible policymaking from the People's Republic.
David.
Yeah, thank you. Let me make a couple of points. So I agree with Dan that, right now everything is kind of put under the umbrella of common prosperity. And I find it particularly kind of cynical that the regulatory crackdown is put under that umbrella of common prosperity. I think a lot of the regulatory crackdown is really focused on online digital firms, Alibaba, the ride sharing, the food delivery, Meituan, and then also these online tutoring firms. And that's a good example where some of the justification for killing the tutoring firms was common prosperity, that this was sort of giving a leg up to wealthy people in terms of preparing their children for the Gaokao, the college entrance exam. The irony, of course, is really wealthy people don't use online tutoring. They actually, they hire the best graduate students to come to their palatial homes and tutor their children, so that wealthy people are not going to be affected. It's just a lot of middle class people, were using that online tutoring. So, so I do think a lot of that, what it really reflects to me is Xi Jinping and the top leadership just not liking these private online firms, the whole virtual world, the cross-border data flows, the fact that these firms are going international, and the regulatory crackdown is really pulling them back. And that was, that's in a dynamic part of the Chinese economy that could have continued to do well.
Yep.
In terms of actual common prosperity measures, I think we should kind of keep our eye on the bottom line. And there's reasonably good data on income distribution in China, both the market-based income distribution and the distribution after taxes and transfers. And China is striking in that it has very, very little redistribution. It has much less redistribution than the United States, which is not exactly the poster child for redistribution through taxes and transfers. And, forget about Northern Europe. So I think it'll be interesting to see, can China actually increase tax collection? There's very little taxation of capital, either property tax for real estate, but capital gains tax, and actually very little income tax collected.
Yep.
So, you can be a reasonable person about tax rates and think there's a fair amount of room for China to increase tax collection. And then there's the expenditure side, and all of us pretty much, I think, tapped into some of the ideas about spending more on education and dealing with this growing elderly population. So to me, the interesting question will be 10 years from now, do we see a significant change in these inequality measures? And I guess I'm a little bit skeptical. I think the lack of redistribution is a pretty fundamental part of the political and economic system in China. I've been in meetings with senior leaders, this is probably 10 years ago now, where people would actually say, oh, Chinese people don't care about inequality. And I think that's probably an exaggeration, but I'm genuinely interested to see, can they move toward a kind of efficient, some efficient redistribution through their fiscal system, or is it really going to end up just being more the lip service and the rhetorical things? And that'll be unfortunate because it won't make people's lives better, but
Right.
it'll seem like a big campaign. Thanks.
Thank you. Tin Lai, would you like to add anything?
Yes, I totally agree with Dan and David. I think common prosperity is indeed a lot of things together, and I don't think there is anything new in there. If we look at the action plan of Zhejiang province in implementing common prosperity, By the way, Zhejiang is designated as a pilot zone in pursuing prosperity. You'll see that the action plan includes 40 plus detailed goals covering multiple categories, including institutional reform, people's raising living standards, high quality reform, disparity reduction, and so on. So it's really a lot of things lumped together. I also want to respond. I also want to add one point related to that, which is I think related to what David was saying. I think China has a serious social mobility problem, and I think that's what common prosperity should be addressing, but it's not. With this widening income and wealth gap, the chances for ordinary Chinese, especially those from rural China, to move upwards on the social ladder is just getting slimmer and slimmer. And the housing bubble, I think, has exacerbated that. And the current school district policy, by the way, is basically allocating education resources based on people's wealth. And this lack of upward mobility is what makes young people, more and more young people, feel hopeless about their future. So they decide to lie flat, meaning that they're just stop. So I think that's a form of wasting human capital potential as well.
Sure.
Thank you. Derek, perhaps we could turn to you to talk about whether technology is coming to the rescue.
Sorry, I'll figure out this volume thing, as soon as the pandemic ends. I should start with a disclaimer. I've been a bear since China responded to the global financial crisis by, as other participants have said, shoving an enormous amount of money through an inefficient system starting in late 2008. That brought forward by many years a decline in income growth that we've seen. It didn't have to occur. It did by Chinese mistaken policy choice. I agree with Dan about nonpartisan China policy entirely, but I want to take this opportunity to be ideological about American policy and say that, I see some parallels between China 2008, 2009 and the US in 2020 and 2021, given what's happened to our money supply and what happened to Chinese money supply at the time. All right, unwanted editorial comment over. An interesting related development to China's growth trajectory, and if the audience wants to challenge on China's growth trajectory, that'd be great. But regardless of what you think of the growth trajectory, there's been an interesting related development in official acceptance, more official acceptance of weak fundamentals. In the last 4 years, you've seen China going back and forth from de-risking to stimulus, with the stimulus never really being quantitatively that large because they're worried. Official demographic data is not as bad as some of the independent estimates, but it's bad. You're not getting the Chinese covering things up and saying everything's fine, which they did for a number of years. Where they remain optimistic, as Des's question indicates, is technology. Technology is going to keep demography and the debt burden from dragging income growth below some magic line. Some people say it's 4%, some people say it's 3%. I don't think anyone should say it's 5% at this point because it dipped below 5% even in the third quarter. But wherever you draw it, growth's going to fall to that line, and then technology is going to keep it there indefinitely. And China will become the world's largest economy, and it could even get shouting distance of being rich because it will just keep growing at 3.8% or more forever. I doubt that. There's always a disclaimer, so I'll put the disclaimer up front. If there's a true technological breakthrough, China could certainly be at or near the forefront of this. I'll throw out AI as the possibility. There's a caveat, which is I don't really know what AI is as an economic variable, despite hearing about it endlessly from hundreds of people. But if there's a true breakthrough in AI, it would maintain, or elsewhere, it would maintain Chinese income growth. Even if income growth surged in other countries, China's size means that maintaining its income growth is more important. So that is a major development if the Chinese could use a true tech breakthrough to maintain income growth. I don't think that's likely, although I can't really measure the probability. And otherwise, it's far easier said than done for tech to drive even moderate Chinese growth. If we take a glance backward, Japan talked about a great deal about innovation, replacing capital and labor as the growth engine, and they couldn't manage it. Talk, didn't work. As China has advanced, it can no longer gain as much from various means of acquiring foreign technology. There are opportunities for technological diffusion within the country, moving inward from areas with larger traded goods sectors to those with larger non-traded sectors. But this is just going to be slower than it was when China was less technologically advanced. You're moving closer to the production possibilities frontier. You just don't have those easy gains. The counter is that China can lead innovation rather than follow, and will therefore get additional and new types of benefits. I find that overly optimistic in two ways. The first has to do with just the difficulty of being a technological leader. The national leader, only benefits for an extended period in income terms if technological ownership can be protected or if new technologies are continuously generated. If instead technology diffuses quickly to foreign entities, then national income growth fades quickly. This is true for everyone. It's the challenge for the United States. It's a challenge for every country. It doesn't have much to do with China. It's just if you want that to drive growth, you're looking at a really big challenge. I think that's uncontroversial. The next statement I make probably won't be. I think the second source of excessive optimism concerning tech and Chinese growth concerns China's system. I can't prove this yet, but I don't believe state-directed resource mobilization, even when it's intense in terms of R&D spending and other measures, can be as durably innovative as a decentralized system. To make this a bit more concrete, for China to have tech-led growth is an extremely heavy burden because it's such a big economy. It's not Israel. Israel can have one technology breakthrough and say, oh, great, we found it, and we're 9 million people. China needs a lot of technology breakthroughs. It needs a lot of identification and exploitation. It needs broad innovation. I don't think the state is up to that. Can the state identify a couple of things? Sure. But the amount of innovation and the durability of innovation China needs, I don't believe in the state-led model. Again, we can't prove that yet, but I would caution people that the state having one technological success is not enough to maintain Chinese growth. Beyond that, and there's a lot to discuss in that claim, but just narrowly in support of the growth side of it, I'm not sure the CCP is even interested in fast income growth from tech development. Some of the interventions starting last fall in fintech say they're not. The party certainly likes social control in its technological development. It likes military capacity. It also likes the other part of Des's questions, which is better living standards. So in my view, the Chinese model is flawed to have tech lead the economy because it's too centralized. But even to the extent it's successful, it may not be aimed at preserving income growth. It may have other goals. Those other goals, the socio-political goals, the military goals are often worrisome, but the better living standards part is not worrisome, and those standards are achievable. So I'm going to switch now to the optimistic side. I don't think China can maintain growth even at a magic 4% or 3.5% GDP line through technology, but I do think they can raise living standards. Better living standards rely comparatively more on in-country diffusion from more advanced technology areas to less. And they rely less on the really sharp challenge of trying to maintain global advantage by repeatedly winning the competition of bringing technology to market. The challenge of in-country diffusion is not trivial. China's struggled with it so far, but it's a lot easier than being a global technological leader. Slower, broad technological development is less likely to be societally destabilizing, which we know is a big concern of the party. And not at all coincidentally, it at least fits with our discussion of common prosperity. As we've said, we don't really know what common prosperity is, but slow, broad tech development seems to work with common prosperity better than tech development as fast as possible, and who cares who gets the benefits. Now, I'll close with a couple little illustrations. 5G. China is the global 5G leader. That has not and will not halt the decline in GDP growth. People who were selling that about 5G were looking for your money. But improved telecom capability has become more important in quality of life during the pandemic, especially with the party requiring physical isolation on quick notice under zero COVID. So it has been more important in living standards than it might have been without the pandemic. Prior to that, if you think that's exceptional because of the pandemic, technological advancement improved environmental quality faster than it would have otherwise. A great deal of money was wasted as China gets these fads where they invest too heavily in certain areas. That happened with a lot of environmental endeavors. So the growth implications are mixed, but quality of life clearly improved. So there's no magic growth minimum that technology can preserve, in my view of the Chinese system. And I think when people sub that in, they're unwilling for cognitive reasons, but more likely for political reasons in China to acknowledge where growth is heading. But on the positive side, you absolutely can raise living standards. It's already happened. I think it will continue to happen. And as a side note, the demographic decline means jobs for all is going to come about at some point, maybe not in the too distant future. So you have better living standards, you have jobs that you don't have to worry about. It's not fast growth anymore, that's gone, but it's not a terrible economic failure either.
Right. But Derek, you're saying that China, your expectation is that they'll be on a very much lower growth path for quite a while.
Mm-hmm. Yes, I think if people are grabbing onto income growth for whatever reason, it's just easy to measure. Most of the people are overestimating Chinese income growth. There's just no way for them to get out of this without sharp pro-growth reform they're not going to adopt. But there are other positives. Yes.
There's a question from the audience, just wanting to know what has been the contribution of technology to China's growth in the past, and presumably that's been very little.
Yeah, I don't think I would say that. Capital, we think of foreign capital as being important in China's early development. China is so big that even when it was poor, the quantities of foreign capital were not that important. What was important was the tech that was being brought in. And so labor has clearly been very important in Chinese growth. And we've had a period somewhat self-destructive where domestic capital has been important in Chinese growth. But I think the foreign contribution, it was really about technological transformation, not new technology, not China developed technology, but bringing in a diffusing foreign technology, which then improved Chinese competitiveness, caused rising Chinese exports and so on. So I think if the question is about domestic technological development, I might agree with that. I'm a little dubious of that. But if it's about technology itself, I think technology has played a very important role in Chinese growth.
Daniel, would you like to say something?
Yeah, thank you. Awesome job, Derek. And just on the point of technology and China's growth, it is what explains the extraordinary total factor productivity performance China had, right? China's growth was more than just the sum of the capital and the labor that went in. They were doubling that somehow. And it was openness to adjustment. We talked about before, all the headwinds to continuing that structural adjustment, too much aspiration for stability coming out of the leadership's mouths. But the other thing, in addition to structural adjustment, was technological change, absorbing technology either by stealing it or investing in it or inviting foreigners to bring it. It's a complicated story, but had a huge impact from an incredibly low, almost medieval base. And that's still the case in much of rural China. The question, though, to Derek, to you, is this, though. Given your low marks to China for its industrial policy system and technological innovation, is the U.S. too interested in replicating some of those industrial policy strategies? And how are you, by virtue of your perch on the hill these days, assuring that we don't go down the road to serfdom?
Yeah, okay. So we're supposed to be all on the same side here, but I get a very barbed question. Look, there are two different things going on. There's the, we need to be like China to compete with China. False. That's false, and it's a mistake. And I'll pick this is not meant to, this is an attack on the Biden administration's rhetoric, but it is not an attack on the Biden administration's fiscal record, given the previous administration's fiscal record. When somebody says we need to borrow a lot of money to improve American infrastructure because that's the way we'll beat the Chinese, I will go back to David's point about I think the Chinese have wildly overinvested in infrastructure, and that is not a model we should be following. So that's an example of don't be like China to beat China. Where, excuse me, I might not be doing the yeoman's work on the hill that you would like me to, Dan, is the Chinese model has harms for the American model we need to defend against. So I am not looking to be like China. I'm not looking to replicate Chinese industrial policy, but I am looking to say that there are harms from Chinese industrial policy. There were harms from Chinese industrial policy 30 years ago. We just didn't care because they were small. Now they're big, and we have to change our engagement with China according to those harms. So the answer is don't make America like China, but be aware that the way China is has harms for the United States, and we need to minimize those harms. And if you want to follow up, that's fine, but you know.
We're already approaching towards the end of our time, so I thought maybe let each panelist have a final word to say, but I guess what I'd be interested in the final word that each of you say, each of you a couple of minutes, is how do you see China's growth going forward? That if you could give some kind of quantification, that would be helpful. But the bigger question is, what should the Biden administration's response be to China? Given what we've all said, and I'm particularly thinking of trade policy. What is the right thing for the US to be doing in its relation with China on an economic front right now? David, would you like to begin?
Thank you, Desmond. I've enjoyed the whole discussion. I think we have a very poor track record of predicting growth in any kind of short term, 1 to 2 year time horizon. There's always going to be ugly surprises. So thinking more in terms of potential, clearly China's potential growth is slowing down. If you're looking out over 10 years, I would pick a number like around 4%, but that's be a little bit higher in the short run as a potential. But I think we all agree that China faces a lot of difficult adjustments. So there could be, a number of bumpy years could easily come along. And then whether or not China can meet that potential depends a lot on policy. And it's very hard to predict what China is actually going to do on policy. Your second question, we didn't really get into very much, but I guess I would say that I think there's still a pretty deep economic integration between the US and China. And more importantly, all of our allies are very deeply integrated with China. So I'm not a fan of this idea of decoupling. I think it's unrealistic and expensive. And the challenge is to craft a much more subtle policy. I guess there are a lot of challenges, and you can say, decoupling is bringing a sledgehammer to the problem when what we really need is a surgical scalpel. There certainly are aspects of Chinese policy that are damaging to the US, and we want to find various ways of protecting ourselves through our own action or multilateral action. But there are a lot of benefits, and I think that China will end up being the largest economy in the world because it doesn't really have to do all that well. If it averages growth around 4% over the next decade, and the forecast for the US is more like 1.7, those are real growth rates. China will end up being the largest economy in nominal terms within a decade or so. That seems likely. So we have to deal with that. And I think the challenge is to find an economic policy that allows all kinds of win-win exchanges, but protects us in the various national security domains. Thank you.
Before turning to Chenlai, it's just struck me that we've been talking about China having a property bubble and a credit market bubble and so on. But I should just inject into the conversation that the United States right now is not in a very different position. We've got equity valuations that are the highest in the last, we've only seen these once in 100 years. We've got a property market, our property prices are now higher than they were in 2006, and there's a huge amount of misallocation of credit. So I guess we shouldn't be the first ones to be casting the stone. But the reason I might inject this into the conversation is it might just add to what Daniel was saying, about China facing headwinds. If the United States has to deal with its bubbles, that might not be a very good external environment, for the rest of the world, including China.
Desmond, if I could just have one sentence in response to that, I think that's very insightful. So, think of a 4-quadrant diagram with with China dealing with reform and sustaining growth on one axis and the US reforming and sustaining growth on the other. And if we end up in the quadrant where both China and the US are doing badly, that's going to be a very poor environment for global economic growth and prosperity.
Right. Tinlai, would you like?
Yes.
Tinlai, do you like a last word?
Yes. Can you hear me?
Yeah.
I was having some connection issues. Well, on the growth trajectory, China has a goal to double its economy by 2035, and I think that requires at least 4.8% annual growth from now to 2035 to achieve that goal. And the Chinese economy has some unique characteristics that allow it to be able to achieve its goal that is set by the leadership. So that would be what I expect China's growth trajectory to be over the next 15 years. And I think given what we discussed, consumption remains so weak, what the model that we will probably see going forward is not, it won't be that different from the current model, which is led by high investment. Perhaps there will be some modifications. For example, there will be less investment in property and infrastructure, but probably more investment in other sectors like decarbonization and those bottleneck technologies. China views itself weak in. In terms of what the youth should do, I think that the youth should keep engaging with China. The past experience has shown that external pressure did work in pushing for some very important structural issues within China that itself is hard to achieve on its own. I guess that's my biggest suggestion.
Okay. Daniel.
On the first question, our little internal exercise tells us that China could pass the US in GDP size as soon as 2027 or as late as never, or 2070. And it all comes down to whether it gets these frightfully difficult policy problems fixed at home. It has much more to do with whether they get their own house through this next phase of reform. And so the outlook is in this incredibly wide range. Next year's numbers, the medium-term numbers, we could discuss those. We have a lot already, but to put it in the context of when and if ever China will actually become the world's biggest economy, that's the upshot of those different numbers. Policy is the independent variable that will determine that dependent outcome of growth. And it's really unclear whether Beijing is going to resolve the evident problem it has in getting this reform work done. Ever since 2013, they've diagnosed the need to do it, but come up short in their attempts to do it time after time. And given that uncertainty about whether China can get that done, how can you really expect the Biden administration to put a grand strategy on the table to deal with China? Which China is it meant to be fit to? One that's coming apart at the seams next year, as Derek seems to think, or one that is making its way to that 4.8% magic average number for the next 15 years that Tianlei said they will somehow find a rabbit in the hat to do. I rather like what I see in Team Biden thus far, not pretending that a grand strategy could be fit to the uncertainty that we see, emphasizing working with allies and keeping our decoupling partial so that we preserve our benefits from the engagement at the same time we close down, as Derek also advised us to do, those things that have been harming us for some years, but now China's too big for us to tolerate. Thank you.
Derek, you've got the last word.
Yay. I'm sure the Chinese will announce that they've achieved their goal. I am, as I said at the beginning, a bear. I think growth is slowing over the next 10, 15 years to 1% to 2%. Demographics make this unavoidable. The Chinese had the pro-growth reform option. They didn't take it. It's done. I'm not saying next year is going to be a huge problem or the year after. That's not the point. They are sliding towards frictional growth because of a demographic burden and because they have not taken the necessary reform steps. and their announcements will be different than that, of course. With regard to U.S. policy, I actually agree with Dan, which is, making a giant commitment is, hallelujah, making a giant commitment here to we're going to do 150 things is probably unwise. We have rhetoric where people are saying, I'm so upset about China, and everybody says this, and then no one does anything. That's also unwise. I would pick out, and we all have just different views here, but we might have an agreement on this basic idea. I would pick out what we need to do now, not trying to commit to how are we going to get ready for China in 15 years when we're not sure what it looks like, but what we need to do now. And I'll just give an example. I think some U.S. supply chains need to be moved out of China. The Congress should set that. It shouldn't be done by executive order. It shouldn't be transient. I would start with 3 or 4, not 20, because the government doesn't know how to do this yet. But there are some things we should not rely on China for. And that doesn't require knowing exactly what China looks like in 15 years. It requires an understanding of, there are certain supply chains that are important to U.S. national security, and we cannot rely on a Xi Jinping government to provide. So I don't think we can come up with a China grand strategy, but I do think we can do more than talk about a China grand strategy.
Terrific. I guess we've run out of time, but it just remains for me to thank you all, for a really great discussion. I at least feel that I've learned quite a lot from this discussion, and I'm sure the audience has as well. So thank you very much. And I think it would be great if we could come back to this issue, in another 6 months' time.